All right, welcome back to another episode of Asset Coach and Tax Strategist. We're going to start this particular episode. We're going to talk about corporate buybacks. I think this is really important for us to understand. Now, before we dive into this, I want to let you know that this is just for educational purposes only. We are not giving investment advice. We don't know your situation. We don't know who you are. This is just generalized information, and just want to make sure that you understand that this is just for educational. If you're interested and you have curiosity, go seek a financial professional about this particular topic. So, what are corporate buybacks? So you may have heard this term, you may not have heard this term. Either way, a corporate buyback is where you have a public corporation that is in the retail marketplace, meaning they're selling stocks to you, the retail investor, through trading on Fidelity, Schwab, right? All of these custodians that you have your money in to a retirement account or in an IRA or in a brokerage account, where you're utilizing these custodians as a place to hold custody of your funds. And then all of these public corporations are registered with the Securities Exchange Commission and have already had an offering of a portion of their the shares of their company that they have sold to the public. In exchange, you get this large lump sum of money. And then the retail space, we get to trade and buy, sell, trade those shares back and forth on the retail marketplace with people in between, middlemen, all that kind of stuff. We're not going to go into all that. So what a corporate buyback is where a corporation, a public corporation, decides that they're going to take their own money and buy their own shares. And they register that as public information, and that they're going to buy back a certain amount of their shares. And what that does is it shrinks the amount of outstanding securities that are out there. So less and less of the retail public have it, and more of the company has it. Now, historically, before 2008, really, when interest rates were what they are now, higher, before the financial crisis, before interest rates went to pretty much close to zero, corporate buybacks were a good indication of the financial strength of a company, a corporation. Okay. Today, when you read and you search this, they say the same thing. But the difference now is that what happened back in 2008 with interest rates going down is money became cheaper. They could borrow money at a lower cost. What's the cost? The interest rate on the borrowed money. And so what a lot of these companies started doing that didn't have any debt, like Apple, for example, they didn't have any debt before '08. And all of a sudden '08 happens and they go ahead and get debt. They sell corporate bonds, and because the money's cheap, so they're borrowing money from the public. And in return, they're offering an interest rate to the public. Okay. And now a company has this money in their coffers, they get to choose what to do with it. So what they're doing with it is they're using this free money, basically cheap money, and buying back their own shares. And so it's shrinking the amount of outstanding shares, the dilution of shares, so that what it does is the share price also is reflectant of the financial stability and strength of the company. But also is that if there's less shares out there, there's less owners. Okay. And so even if a company ends up having a difficult financial situation in their business model, then buying back shares is still a way to hold more of the ownership of the company to themselves as a corporation. What's interesting about that is that when a company also pays dividends, they're paying themselves dividends. No different than when we hear Treasury and the government owns Treasury. Well, it's almost like we're paying ourselves money, right? And that's legal. It's completely legal. So what I'm going to do is I'm going to share my screen. And again, we're just doing high level. We're not driving into the details or anything like that. I just want to share with you some of what could be happening. Now, you and I as investors can piggyback off of this. right? We can piggyback off of this corporate buyback and hold on to our shares and see the value of our shares increase. But it's not necessarily, I want to make sure it's clear, it's not necessarily due to the sole financial strength of the company like it used to be. Okay. Just like when I talk about the S&P 500 and you have the Magnificent Seven, the top seven companies in the S&P 500 that's driving the return of the S&P 500. It's no longer a benchmark, right? When you have seven companies out of the 500 that are driving the rate of return. Okay. So anyway, so when we Google corporate buybacks by year as an example, AI, with Google right now does everything AI first. So let's look at that. In the first quarter of 2024, S&P 500 companies spent $236.8 billion on share repurchases, which is an 8.1% increase from the previous quarter. The 12-month period ending March 24 saw a $816.5 billion buybacks, which is down from the 867 for the previous 12 months. Okay. Crazy, right? That's a ton. In 2022, US corporations spent over $1 trillion on buybacks, which was a record. Okay. And this is what happens when you have a low interest rate environment, right? As a business, you can make decisions based on the cost of gathering money. So you're a business owner. Is it cheaper for you to go borrow money and pay that interest, or is it better for you to go out and market and do ad spend and marketing and spend all that money to get that same amount of money? What's that cost? Well, it could be actually cheaper to borrow the money and use that borrowed money to do your marketing and advertising, right? To get a return on that, grow your sales, revenue, profit, to pay back that interest on that debt and principal. But it's not your money, it's their money, right? And so this is how businesses leverage debt. This is our fourth D in Terra Firma when we talk about our asset buddy system. The fourth D is debt. Leverage. How do we use leverage to your advantage? And so it's good to understand how that works. Okay. So if we looked at, and I click here, if we looked at the last 12 years, okay, so 2010, so they don't show 2008, but 2010, there was an increase by 16%. 2011, 46%. Then it dropped off in 12, 13. You can take a look at this. Look at this. 55% increase, then a drop off, right? Then they went back out, 71% increase. That's probably because there's such a huge double-digit drop off for two consecutive years. Okay. And what happened in 2020? Interest rates, right? Even though inflation went higher, right? The buyback and being able to offer corporate bonds and everything, actually, this was the chance to be able to do that. And then that's why we only saw a 3% rise, because interest rates were increasing. 2023, where was inflation interest rate? A lot higher. So the buybacks decreased, and then so on and so forth. So when we look at this, looking at the four reasons why investors like buybacks, it's good to know. So basic buybacks, you can go get this. It improves shareholder value. So again, what I was saying is that it reduces the amount of shares out there. So if you have less shares, and the value makes the share price higher, right? Or stronger. Or the same, if they're having a financial difficulties, they use the share buyback because they got cheap money to hide the results of what's going on. And the share price continues to stay stable. It boosts share price, tax benefits. Now, when excess cash is used to repurchase company stock, instead of increasing dividend payments, shareholders have the chance to defer capital gains if share prices rise. Meaning that instead of a company saying, hey, we're going to give you money back as a dividend, as a shareholder, we're actually going to repurchase stock, and then the value of that your holding increases, which is you don't pay taxes on that until you sell that stock or that holding, and that's when you pay taxes on capital gains on the gain. Okay. And then excess cash in a sign of confidence, meaning that they have money set aside. And so that money set aside as a company is going to buy back shares So this is again before 2008. The thought process is that the company is financially doing well. Okay. But this is all in Investopedia. You can go on Investopedia. That's why I like using this. It's public information. You go check it out for yourself. Benefits of share repurchases. Again, so you can go back through here. What is it? The tender offer, open market. It kind of goes through some more education. They use Apple as an example. Why? Because I'm going to show you here in a hot second why that's important. So, all right, let's go to Apple. Is this Apple? No, this is Alphabet. I want to show you Alphabet too, which is Google. Okay, so this is the Securities Exchange Commission's website, and in to prospectus date November 5th, 2018, they were raising $7 billion. That's billion, $7 billion. Well, they're a $1 trillion company, so this is a drop in the bucket, right? To raise this. But look at the interest rates. This is the point that I'm looking at, is that when the note is due in 4 years, 6 years, right? So the longer the note, meaning the longer they hold your funds, the higher the interest. But look at these interest rates. Way, way low. So they're getting $7 billion and they're barely paying anything. Now they are paying paying this to get, right? This is the cost of the money. But what are they doing with this $7 billion? They're buying back shares. Okay. And with that, and they're not using their cash. This is why they have so much cash on hand. Instead of using their own cash, it was cheaper to buy cash, borrow, to get that money and use that money to corporate buyback, and they sat on cash. Okay. Alphabet did the same thing. By the way, this is one of the Magnificent Seven. Apple and Alphabet's the other one, right? So look at what Alphabet did. $10 billion. Okay. And this is as of 2019. Look at the costs on these, right? So they got $10 billion. Now, sure, don't get me wrong. These companies may be using some of this money to invest in the business and buying other companies and R&D and all that kind of stuff. But the reality is that this is cheap money. So it makes sense to add this money to your cash pile. So you're not using your cash. Your cash can still go out and earn money by going to R&D, to buying other companies, or just putting it aside and earning whatever return they get on the private marketplace. Or does it make more sense to leverage, go get cheap debt, and then turn that cheap debt into buying back share prices? I mean, buying back shares. And what's that do to their share price? It goes up. And if they're paying a dividend, they're getting that dividend back. And a lot of times the amount of dividend back is going to actually bring back a return to the company to actually have what's called a positive arbitrage, meaning that they are able to have made more money after they paid back the cost of that debt. Okay. It's really smart. Every business goes through this. Every business goes through this. The government goes through this through the taxes, right? This is why they give business owners deductions, credits, rebates, and incentives, different ways to reduce their tax liability by taking revenue and your expenses, using your expenses to create deductions. So you end up having profit. The government, the IRS, could tax top line revenue. The reason why they don't do that is they give us that ability to save money on taxes so we can take that extra cash flow, and what are we going to do it? Put it back in our business, grow our business, hire more W-2 employees, and they get more tax revenue. So the government uses taxes to generate additional revenue. Okay. So that's the same thing here. Right. So they're creating additional revenue. So when you have people who hold a portfolio who all of a sudden have made, 2, 3, 400% on a particular stock, and they decide to sell it, what happens? It creates a capital gain, which is a taxation that goes to who? The government. Okay. So it all benefits everybody. And by the way, when a company borrows money, that interest is an expense to the company. So even though they're paying out this interest percentage, it's an expense. They're writing it off on their profit, their revenue. So Just wanted to record this quick little video. I thought it's just interesting. And yes, you as an investor can piggyback off of this, right? And but when things go awry and the economy goes into a recession or something negative happens, you can't rely on a company to continue to buy back shares if that happens. Now, it behooves them to buy back even more shares when their stock price goes down. So they may actually stop buying back shares when they see a recession, because what'll happen is that if they stop buying back shares and they see their earnings going down and they're going to start seeing their stock price going down, why would it behoove them? Because if their stock price goes down, you and I as retailers may want to sell our share before we lose that 300% gain. And what they'll do is end up buying more shares at a cheaper. Makes sense, right? It's why we go to different retail stores when the things are on sale. We can buy more product and with the same type of dollars. Same thing here. So I'm not saying they're manipulating it or anything like that, but they win either way, which is good for them. That makes sense. You win if you're piggybacking off of that. My only point is just be aware of that. That's all. I'm not saying this is good. I'm not saying this is bad. I'm just saying be aware of it. I think it's important to know. We talked about two of the largest companies in the world with Alphabet and Apple. What about the less largest companies in the world that are doing this? And you're holding those in your portfolio. How does that affect your portfolio? Don't know. Talk to your financial advisor about that. What's that look like? Do some research on your own, which is what I would prefer you to do. And if you have any comments, please put comments down here. If you have any like this content, give us a thumbs up. Go ahead and subscribe if you haven't subscribed yet. But anyways, I thought this was an interesting topic, so thought I'd record a video for you. Thanks so much. Make it a great day. Bye-bye.